I think it's important we examine the role of risk tolerance in crafting your investment portfolio. The role of risk tolerance in crafting your investment portfolio. Risk tolerance is an investor's ability and willingness to endure fluctuation in portfolio value. Your ability to stomach the inherent fluctuation in a typical investment portfolio. Your portfolio value is going to climb and drop. It will fluctuate, a lot sometimes. So your ability to stomach, to bear that fluctuation is known as risk tolerance or risk tolerance. Understanding your risk tolerance is essential for constructing a portfolio that aligns with your financial goals and emotional comfort level. So here is how to incorporate risk tolerance into your portfolio design. Number one is you evaluate your risk tolerance. Evaluate your risk tolerance. So in this case, you would consider, the need to assess your emotional comfort. They need to assess your emotional comfort. So reflect on how much volatility you can handle without making impulsive decisions. For instance, ask yourself if a significant short-term loss will lead to panic selling. You need to answer that question. In the case of a fluctuation, in your portfolio, will you rush to sell your stocks? So equally, take into consideration the financial capacity. You consider your financial capacity. Determine how much risks you can afford based on your financial situation, your income, as well as your savings. For example, someone with a stable income might take more risk than someone nearing retirement. Number two is identify your investment goals. Identify your investment goals. So you may have short-term goals as well as some long-term goals. Let's look at the short-term goals. If you need, funds within 1 to 5 years, prioritize low-risk investments like bonds or money market funds. But if you want to actually, consider the long term, if you have a long-term goal, in this case, you do something different. For goals, above 10 years, higher risk assets like stocks may be appropriate for their potential to deliver greater returns over time. If you are considering a long-term goal, in that case, you may dabble into equities that will give you the kind of returns you will need over the long run. Number three here is match risk tolerance to asset allocation. There's the need for you to match your risk tolerance, with your asset allocation. In this case, you consider a conservative investor, you have moderate investors, and you as well have aggressive investors. So if you are a conservative investor, you prioritize stability with higher allocations to bonds, cash, and other low volatility assets. Example, you may allocate 20% to stocks, 70% to bonds, and 10% to cash. So if your risk tolerance is at the moderate level, you have a moderate level of risk tolerance. So you need to balance risk and return with a mix of growth and income generating assets. For example, you may allocate 60% to stocks, 30% to bond, and 10% you may go 10% cash. On the other hand, if you are the aggressive type, you are an aggressive investor with an outsized risk appetite or risk tolerance. So you may focus on growth with a high allocation to stocks, accepting more volatility. Example, as high as 80% could be allocated to stocks, then 15% of your capital to bonds, and then as little as 5%, in cash. Number four is consider diversification. You consider diversification. So spread investments across different asset class, across different industries, and also different geographies to reduce risk while maintaining growth potentials. For example, include domestic and international stocks. You may also incorporate government and corporate bonds, as well as alternative investment like real estate investment trust. Number five, use age-based guidelines. Age-based guidelines. In other words, you invest in accordance to your age. So in this case, younger investors can afford more risk and may allocate a higher percentage to stocks. The younger you are, the more your risk tolerance, all things being equal. And so older investors nearing retirement may reduce stock exposure in favor of more stable assets. A general rule is to subtract your age from 100, and so whatsoever is the result, is the percentage you are going to allocate to stocks. For instance, if you are 30 years, let's say you are 30 years old, you subtract 30 from 100, that will give you 70. So in that case, you allocate 70% of your capital to stocks. So please like this video and subscribe to this channel. It will do me a ton of goods. It will motivate and encourage me to keep on bringing contents of this nature to you. Number 6 is account for risk adjustment over time. You need to make accommodation for risk adjustment over time. You account for risk adjustment, over time. In this case, you consider life stage adjustments. As you age or your financial goal changes, adjust your portfolio to reflect your evolving risk tolerance. As we grow older, our priority, our financial goals, our risk tolerance, everything about us, tends to change. So you adjust your portfolio accordingly. Then you also, need to rebalance. You consider rebalancing. So in this case, periodically review and rebalance your portfolio to maintain the desired risk profile. You keep on adjusting and tweaking and rebalancing your portfolio to be able to accommodate your risk profile as well as your investment objectives. Number 7 is test with hypothetical scenarios. You test with hypothetical scenarios. Use past market scenarios to estimate how your portfolio might perform during volatile periods. You need to carry out that financial modeling, so to say, to be able to know precisely how your portfolio will react, in case of fluctuation or volatility in the markets. So if the potential losses, make you uncomfortable, adjust your asset mix to reduce your risk. If you feel you cannot really accommodate the outcome of your test, if it proves too risky, then you need to readjust your portfolio to make it safer and kind of more stable. And number 8, you seek professional advice. A financial advisor can help you accurately assess your risk tolerance and recommend an appropriate portfolio strategy. You could engage their service. They may charge you, some amount, but all the same, I want to believe the outcome will serve you better. In conclusion, building a portfolio align with your risk tolerance ensures that you can pursue your financial goals while managing the stress of market fluctuations. By evaluating your comfort level, financial capacity, and investment timeline, you can create an asset allocation strategy that balances growth with stability. So it's very, very important. Now, when you want to invest, you must consider your risk appetite in mind. It's very, very important. But that will determine the kind of strategy you are going to adopt at the end of the day.